Thank you for joining iMeet. When you hear the tone, you will be the 15th person to join the meeting. This meeting is now being recorded.
Hey everybody, good afternoon. This is David Blake with the Tuesday Tech Talk. And today we're going to quickly review the last couple of days in the market, try to figure out what the market wants to do over the next couple of weeks, and then we'll look at some different indexes and determine some support and resistance levels. And then we're going to talk about the CTI. We've had a neutral market posture, and as of last Friday, we finally rolled over to a bearish position. What I want to do today is we're going to look at the different charts, and we're going to see what changed in the different indexes in the market to make the CTI move or the market posture actually change from neutral to bearish, and why we might want to have a little bit more caution in the market going forward. If you're new to the Tuesday Tech Talks, I usually talk about 20 to 25 minutes. Unfortunately, it goes a little bit longer than that usually. And then we open it up to questions from you. You can ask questions about different stocks, different indexes, different segments of the market, industry groups, whatever, or individual stocks, and we'll take a look at some charts and see if we can help you out. Okay, just get started. Let's take a look. Here's the Dow coming up. Last week, like I just mentioned, we had a shift in the market posture from neutral to bearish. The major averages were mixed last week, with the Dow Jones outperforming, and as of yesterday, it hit 30 record highs so far in 2017. Today will probably be the 31st. The Dow was up about 1.2% last week. The S&P 500 flat. NASDAQ was down a little bit, and Russell 2000 was down about 0.5%. Now the weak link was again the Dow Jones Transportation Index, which dropped about 3.1%, and that was on top of a 2.7% decline the previous week. So we are getting a correction in that. And we're actually down today, despite the Dow being up about 90 points. The transports are down another 0.5% today. Okay, the CTI is a -4. It'll ease down to a -5 this Friday. Then we could reverse to a bull call again on the market as early as maybe 8.18 or 8.25. So if you're looking for to trade the leverage CTI or the leverage ETFs like we've done the last couple of years, it's going to be kind of a short window, and we'll have to see what happens here. But what would extend the call past 8.18 or 18.25 would be the Dow Jones making a lower intra-week low. Every time it does that, the CTI or gets pushed out, or the cycle gets pushed out another week until it stops making new lows. So you can catch this thing towards the end of it, and actually the call will stay a little bit longer. Okay, those not familiar with the CTI, it's a cyclical trend index. You can read about it on the market site, and basically it's about different cycles in the market that we've tracked since 1974, been live with the trading of the CTI since about 1991, has outperformed the Dow about 2 to 1 over that time period. Now the reason we went from a neutral market posture to a bearish stance on the market was our momentum index last week went from a +1 all the way down to a -7. And what that reflects is that the other indices are underperforming the Dow, and that negative divergence triggered the shift from neutral to bearish. In addition, we had a move into negative territory on the sentiment index, which measures bullishness and bearishness in the market. It went to a -2, which means that the level of market bullishness is again getting to the top of the range where we'd like it indicates a red flag coming off. So I don't see anything yet that's looking for a breakdown in the market. It's like a 10% or like that, but the CTI has a strong track record, and it just with the negative divergence that we saw and the slowdown in the momentum and the Dow walking alone a little bit here, it just is just calls for a more cautious approach, despite the fact that the Dow just keeps marching higher by itself. So let's take a look first here at the Dow Jones. Not too much not to like in here. We're up here bumping against 22,000. We're 21,984 right now. The indicators down here are all supportive of higher prices. We're breaking out to a new high, getting a new high on the 14-day RSI, the 30-day stochastic staying up. Accumulation still stays strong. And one thing you want to look up here, and we've done this before, if you take your thumb and your first finger and measure areas of the market from the 50-day up to the top of that range, how far it got away, how far it got to here, and you can go back and see where it gets extended. And a lot of times there will be a reversion in that, and it's an easy way to tell when we're getting overbought. If you do that, look at this, and you look at over here, this probably gives the Dow Jones room to get up to about, let's see, I was going to say to about 22,350 on the upside if we don't get any kind of a pullback in here. I would be that would probably be at the extent of it. Our old target of 21,850 was hit last week or Monday, one of the two. So we have had that. We have hit all our targets on the upside on all our indexes. Okay, here's the advanced decline line. And again, we watched it in here. We broke out the new highs again. But you have a little bit of a slowing down, a little bit of sideways action in here, but nothing that's saying, showing negative divergence in this. It's just not quite getting the rapid move like you had here. We're picking up about 400 units today, but the Nasdaq actually, even though it's up for another day, has more declining issues and advancing issues, and that's been going on for a while. Again, negative divergence that you want to be aware of on that. Now here's the S&P 500, which has underperformed the Dow. This is what you want to focus on today, some of these charts that we're going to look at besides the Dow. As you can see over here, let's see, we're bumping up against this record range again today, not quite breaking out to a new high. The Dow is up. When the CTI went negative, what we do from there is we measure the old highs from here, and then we want to see how far the other indexes or the Dow are either up or down against the highs that we recorded in early June. So with the Dow up from the high that it made in June, is up 1.68%. The S&P 500 is only up 0.67%. So that's part of the negative divergence you're seeing in here. It's underperforming. Now you also have actually a sell over the last day or two on the S&P 500 on the MACD. You also have a non-confirmed high where it comes out here and you're not getting a new high in the 14-day RSI. You want to see that when it's making new highs. You want to see the next new high, again, go up into this range. You're seeing a little bit of a turnover here on the 30-day stochastic. So that's a few red flags that we want to take a look at on that. That's helping to bring the momentum indicator down. Here's the NASDAQ. Again, we broke out to this new high. We had this June tech wreck where we thought we were going to get our pullback. The CTI went negative somewhere right around in here. We've been neutral for this area. Now we're starting to get a little bit of a pullback again. Again, we're having an underperformance by the NASDAQ. We came down here, tested the 50-day, turned around, and bounced back up. However, we have this negative divergence going on in the 14-day. Again, we're up here pushing the new highs, but we're not getting a new high in the 14-day. We also have a sell here on the histogram going actually negative momentum on that, and a sell on the signal lines. 30-day has fallen below the 80 level. But, this is, here I'm showing you right here, we're making new highs, yet the advanced decline line is trending lower. Not heavily lower, but it is showing negative divergence. It's showing it's not a sign of strength as much as what you have on that. And I think the NASDAQ is off of its June high. It's up only 0.42%, so it's underperforming the Dow by more than 1% also. More negative divergence, and again, you have another index that's not confirming the Dow's push to a new high. And again, this is okay, but not great. And I don't like to see the Nasdaq up here pushing new highs when you have more declining units than you do advancing units. That's one of the negative divergence things that we're talking about. Here's the Russell 2000. This is a small cap index, which you normally want to see, especially when the economy is taking off. You'd like to see the leadership in this. Lately, this last bit of a pullback here, you can see where we were in this range for, going back to December. We made that huge move off of from the election. Everything was going to be great, lower tax rates. The Trump effect was going to go in effect, and then we went sideways all the way through here. Finally broke out here a couple weeks ago, moved up here to this resistance area, and now we're coming down here where we're pressing. We're going to test this breakout level here, which is just above the 50-day moving average. So we're kind of in an area that you really want to watch. The 50-day comes in around 1410, 1415, and then if it breaks through that, you could get a test down here, the 1395 area, which is the 100. Again, you had the sell area here in the MACD, and you have negative momentum on the 14-day. That's non-confirmation of the Dow's move higher. You have you're breaking out to new highs, but you have a flat 14-day RSI on the 30-day stochastic, where I use this a lot to see it, to measure the change in trend. You're getting down here into this 50 level. A move below 50 would be more of a red flag, and just more negative divergence to the Dow's move. When I said that, I don't really expect a big pullback from what the Dow's doing. We have low interest rates. We have great earnings. However, when you see all this negative divergence coming together all at one time, at least it raises a red flag that I would not be putting new money in here, chasing the Dow higher. Well, I would more inclined to sit on what I have. If I am going to look for some places to put some new money, we'll look at that here in just a second. Okay, here's the Dow Jones Transportation Index. If you're looking for a confirming indicator, this sure isn't it. Here you saw that from this move back in at middle May to the high there, we've already retraced 50% of that whole move. We came down here to the 61.8% of the retracement. If it breaks this 91, well, we broke it today. If we break this 91, let's say 91.12, 91.40 area where we're 91.28 right now, down 0.6%. That usually what happens. If it doesn't hold this 91.12, like you can see the Dow Jones Transportation Index retrace this whole move. That's normally what will happen if you go up that fast and you retrace it that quickly. So the transports are in a position here where if they break down much further, they could probably pull the rest of the market down. Here you can see the rollover, the advanced decline line. We're already below 20 on the 30-day. When it gets below 20, that means you've got a stronger trend going with the index. And as long as this thing stays going sideways, that means it'll be trending lower. Here you have the RSI. We finally broke below that 40 level. If the trend changes from bullish to bearish, that 40 level won't hold, and you'll start to see this thing go down into the 30, maybe in the high 20s. That would be a confirmation sign also that the transports are probably heading lower. And again, you have this negative indicators in here with that. So if you take anything from this today, we got the generals marching the loans, what they call it on Wall Street, when the Dow blue chips are marching everything, and it's not being confirmed. So you want to, what we're trying to do right in here with this negative divergence is to hold on to the money that we have. We're not trying to be a hero and saying, hey, I don't want to miss this last move up. We've been long for the market for a pretty good long term. We've been holding on during this neutral position, let the market take you out. But the big thing to do is you don't want to be taking all the risk when there's this many red flags coming in there. The object here is to hold on to our money, and we'll put it to work when we get a chance. Okay, if you miss 100, 200 points to the upside, it's not a big deal. So anyway, what I want to look at over here, we have the best performing sectors for the one week from last week. That's utilities, up 1.81% is that was because we had a backup in the 10-year Treasury yield. It went all the way down to 226, which is surprisingly not keeping a lid on the financial sector right now. You've had a couple of good days in the bank stocks and insurance stocks. You usually don't have that when the yield's coming down to this 226 area, because it was just around 235, I believe, about just a couple of weeks ago. Yeah, the energy, you've had a heck of a move in the crude oil. We're having a little bit of a correction today. We're down about 3%. It bounced off that 50 level. Here's the consumer staples. They're up a little bit, and REITs are up a little bit. That's because of the slowdown in the 10-year Treasury yield. So the rest of the indexes or sectors are basically negative. The worst ones are the XLI, the industrials. That's been the weakest wing, and it's down again today because of the the auto manufacturers came in much less with the July auto sales than was expected. All right, I'm going to go over this right now real quickly. If you are if you're kind of a bear on this thing, some of us have traded this the triple leveraged ETFs. It's an inverse ETF that goes opposite. If you do, we do the four indexes. We do the Dow, the S&P, the NASDAQ, and the Russell. If you traded these last year, we made about 60%. This year, you're basically flat. I think you're down 1% if you're on these things. If you follow the market letter, you may have gone in on this on Monday at the open. If you did, you're up in 2 and down in 2, so you're basically about flat right now. But these are the symbols of those leveraged ETFs. If you're not in them right now, you may want to wait tonight to see what happens with Apple, which we'll talk about a little bit longer. We could have a market. Apple's earnings could move the market either higher or lower tomorrow, so we want to watch on that. But those are the symbols for that. Now, here's a couple charts I want to look at that also is that we've looked at the last couple of weeks. This is the light crude oil contract that we looked at. We talked about this a couple of weeks ago over in this area where I thought that this would be. I've been bearish on oil for all year long. And I thought here about 2 or 3 weeks ago that we could finally get that breakout in oil prices, which we have. We came up today, hit 50, and now we're coming down here struggling around the 200-day moving average again. We'll see how that holds. That was kind of a big deal that we broke above that yesterday. I don't see much more upside in this thing. I think we could get to the 51, maybe the 52 area, which would test the highs back here from June 1st. If you bought the oil stocks down in here, you're probably pretty happy right now, and we're just holding on. We're not looking to get aggressively long anymore. We'll hold what we have and see how this plays out over the next couple of weeks. You also have confirmation that we're still the trend is improving here by this, and over down here you can draw resistance lines and trend lines on indicators also, and when you see them break above those resistance lines, it's also a big plus. So oil still looks like it can consolidate this little bit of a move in here, and maybe get up to this 51.5, maybe test the old high over here. I would hold on to those stocks that we picked up and we've talked about the last couple of weeks on that. One of the big factors besides OPEC and supply and demand, and we talked a little bit about this last week too. This is the daily chart of the UUP, which is the bullish dollar. It's the U.S. dollar. Everyone's talking about how the dollar is getting weaker and weaker. This shows confirmation. It's actually a little bit oversold in here. I believe last week we said that we should be able to find support on the short term for the U.S. dollar right around on the ETF here, about 24. So we are probably going to get a little bit of a bounce or sideways action in the dollar, which could slow down the advance in oil and gold and stuff. But if you go out a little bit further, this is a weekly chart going back 2 years, and you can see again that this this 24 area should be an area of resistance. And again, when the dollar is weaker, and we talked about this intermarket analysis last week. I hope some of you bought John Murphy's book, because it is a good one. When the dollar's getting weak, it's going to help. It helps gold. It's going to help the emerging markets. It's going to help oil and commodities. We talked about copper last week, breaking out to new highs. We looked at some of the trading ideas that were in the point and figure breakouts and all. We had one of them was SCCO, I think it was Southern Copper. The next day we had a gap up on that thing. It went up like $2 or $3 from like 34 to 37 or something like that. So we had a couple of places that we showed you where to find some trades in the commodities. But with this weaker dollar, we're also seeing gold prices go up. Now, for as much as the dollar's gone down, I would actually have expected gold to be a little bit higher. But you can see this well-defined trading range. We have a double top up here. I expect to see gold at least make another run up to this 1295 to 1300 level. We'll see what happens there. If it breaks through that 1300, you can get yourself another trade of maybe up to 1320 as long as the dollar stays weak. The indicators are showing it's not overbought yet, working its way higher. I still think that, like I say, we'll probably get a little test of that. We're up to 1277 right at this moment. 1280 is resistance, but what's going to happen? We're going to see if this is going to be a double top or not. I'm tending to believe that we may get a little bit of a push, especially if the dollar breaks that UUP breaks that 24 level on that ETF. That could give us another big push, and it could also help push oil back up to the 52. So I think as far as the gold mining stocks, you're not getting big moves on the ABX. I think we looked at that last week. But some of the other mining stocks that would benefit from a weaker dollar look strong in here. Now this is the gold weekly 2-year chart. You can see we've been in that trading range, and again, when we get up here close to this that double top, if we break through that, it's going back several years. We could get up in that 1330 area, somewhere like that, 1325 area. Okay, this is the industry group analysis for right now. We're talking here. What can we benefit? What areas of the market benefit from the weak dollar? Looking over here, you have metals, non-ferrous. You have diversified mining. That's going to be your gold. You also, right now, I'm not sure why the insurance companies are rolling in here, but again, this is showing you some places where you can find some stocks if you haven't bought any yet. Go in here, click on the industry group, go to this diversified mining or metals, non-ferrous, and find the strongest stocks. That's the place where I would look. I would also go up here in advanced tools and look at the point and figure breakouts, especially the point and figure early alerts. Rank them by the power rating, and you're going to get a couple stocks that will be listed that are ready to break out. That SCCO showed up again today as a copper stock ready to break. Okay, here's that SCCO right here. This is where we were talking about it last week. We got lucky on that call. We see here's the gap up, and we're going sideways on that. A little bit overbought, but that was one that we talked about last week briefly. Let me move on to. Okay, when we talk about the inverse relationship, these are this is from our smart chart. Okay, here's. This is something the emerging market versus the U.S. dollar. One of the other places besides commodities that benefit from a weak dollar is emerging markets, and also countries that benefit from their economies benefit from higher prices for commodities. This is the EEM versus this is the UUP going down. This inverse relationship has worked out well. When you talk about intermarket analysis, you certainly want to see what's working, and then you know that you can move forward with those trades if you're aware of what's supposed to be happening. In this case, it's working exactly the way you wanted to see it work. So the emerging markets could probably still work for a little while. They are maybe getting a little toppy because this is oversold, and I think that maybe you'll get a chance to buy the EEM. But some of the emerging ETF funds that would be in there would be something like, here's Mexico. It's having a nice move. You wouldn't think Mexico would be a big place you want to invest, but they're going to benefit from the rising commodities. Also, maybe Russia, but a little bit iffy on that. Maybe you look at Brazil. They've got problems with their government. You may not want to go there, but it's maybe South Africa. You want to be selective, but you look for some of these emerging markets that have that, get a lot of their money from commodities. Now, if you don't want to risk going into something like Mexico or that, two of my favorites right now, here's Canada. Canada's economy is almost all based on gold and oil and that kind of stuff, and the different mining stocks that they have. Here we have a breakout going back towards the first of the year, and you have a little bit of a pullback here because we had such a big move from this. But I still think you have plenty of room in Canada to move higher. Here you're starting to see the accumulation starting to go up. Another one similar to this, here's Australia. A little bit more thinly traded, but here you have the same thing going on here where you have the dollar starting to break down more than you had the commodities. The ETF for Australia, EWA is the symbol for this. EWC is for Canada. And you can see the accumulation in Australia going higher. And you're getting confirmation from the 14-day RSI also. So that's some areas that if you're looking for places to park some money while we see what's going to happen here with the Dow or with the broader market, which I think we're probably. It wouldn't surprise me to come in here and we can take a 200 or 300 point down day. That could trigger some more profit taking. And remember, if we do get a 5% pullback, which is not, that's pretty much garden variety, you're talking about 1,100 points in the Dow Jones. So something that would give you a nice return on those leveraged ETFs. But again, that's a very speculative trade. If you haven't done that with us before, you'll risk 8, 9, 10% on that trade, and then you'll cover it. So that's what I want to do next here. I want to get in here, get your questions up. We're going to look at that. I didn't want to go over a lot of too many individual stocks or point to stuff, because we did that last week on some of these commodity and gold and oil trades, because I'm not looking to chase anything else, and I don't want to be jumping into some stock trades at this point. I'll hold what I have and let the markets take me out of what I have. One last chart I have here. Oh, okay. Before we get to the questions while you're putting them in here, tonight we have Apple that's going to release their earnings. And again, I think that this is if you're not long the triple leveraged ETF, maybe you may want to buy a half position. If Apple beats, we could get another pop tomorrow. If they come up a little bit low, you're going to get you can see the market pull back, and then you can add to the position at that stage. What I'm also waiting to see is whether or not Apple says they're going to delay their iPhone delivery here. You can see right now it's trying to hold on to this 50-day moving average. Let me see where it is right now. It's flat right here as we're talking today. So holding on to this 50-day, we get something down here. First support is 146 and change. That's the 100-day moving average. If it breaks through that, then we'll see about going back here to this 142 level and see what happens to that support level. So again, that's probably going to move the market for the next couple of days anyway, to see what happens with that. It's because it's such a heavily weighted component of several indexes. Okay, so let me get to a couple of questions that we have right here. We're saying that oil has peaked, or is there room to go beyond 50? Yeah, I think that oil can. It's 50 is kind of a line to stand for, but I think it's going to take it out here. I think we can probably see it easily to 51, and then we'll maybe bump up against 51, 52 in that area for a little bit. I don't see it breaking out to the $60 by any means. I'm not a long-term oil bull or anything like that. We called that. We got lucky a couple weeks ago and got that. Thought that we could break out to higher prices, and that was a good move. So I'm not looking to buy new positions in oil at this stage. I'm holding on to what I got, and I think I can make a little bit more money in that area. So $50 is just a kind of a psychological support, a resistance area. I think it's got a little bit more room in it. Okay, Linda says, is the weak dollar enough for the metals and the emerging markets to continue to go up, or does the dollar have to be weakening more and more? No, I think it's pulled back enough. Again, we're oversold at this stage, So I would, I think, you consolidate a little bit, maybe you bounce a little bit in the dollar, and I think as long as the global economies seem to be moving higher together, that the emerging markets in this case will stay. If the dollar, which we have plenty of time to catch if the dollar is going to all of a sudden spike up for some reason. I don't know why it would. One thing that would have made it spike a little bit higher would be if the Federal Reserve was more aggressive on their interest rate hikes, which they've softened that tone a little bit here the last meeting. September is 30% or the chance they're going to raise rates. I think we're talking December is only about a 50-50 now, if that. So that should keep pressure on the dollar, keep it from rising too much. But it also it has oversold areas, and again, I think right now we're oversold on the dollar, and we're due for a little bit of a bounce. So if you do get a bounce on that, and you get a chance to go into some of the emerging markets, that's when you'd want to go into those. Any more questions coming up? We've gone about the 30 minutes, which is what I like to keep it at. If you have any other questions that we don't get to today, you can send them to the doc at marketedge.com, and I'll try to answer. I'll get back to you with later today, or you can go to support@marketedge.com. With nothing else coming in, I just want to say I appreciate you taking time out of your busy day to join me with this. I appreciate that, and I hope it was worth your time and you got something out of it. And we'll see you again next week. Thank you.